Hey everyone, welcome back to Vulcan Motorsport, your all in-depth car review and motorsport journal here on YouTube. We're going to be doing things a little bit differently today, a little bit of a how-to guide, so to speak, and this kind of follows on from the direction that I was going in from the previous upload that I did about ULEZ charges and how you can avoid these fines in London. I'll leave a link in the description for that one too, so be sure to check that one out right after this one as well. So this video is going to be all about PCP, or something called personal contract purchase, how it all works and how you can benefit from this type of financing. Now this is coming from someone who has a background in banking, and so typically I'd come across clients who are involved in different types of finance schemes which aren't necessarily vehicle related, but largely the principles at work here are near enough the same. And no, I'm not going to be giving any financial advice, I'm merely going to be giving my understanding of PCP to help you the viewer and you the buyer. For anything official, you should always seek professional independent financial advice, speak to an accountant or something like that. So with that being cleared out of the way, and if you're in the space of purchasing a brand new car ahead of the changes that are going to be coming into the UK from next year, this guide will give you a better understanding of how this concept all works. And with that being said, let's get into it. So just to get some formalities done and out of the way, what you're watching in the background is the launch of the BMW 4 Series. This actually came out a couple of months ago, and the car's actually had quite a bit of stick for the new grille. I for one don't actually mind. The same with the G80 M3, I actually think it's not too bad, but that's a discussion for another day. And so just for a brief introduction, the majority of new and nearly new cars sold each year in the UK are being bought through financing options, with PCP Car Finance being by far the most popular option over the past few years. Around 80% of new cars you see on the road every day have been bought through a PCP deal, along with a growing amount of used vehicles too. Now, it's easy to see why this type of payment plan has exploded in popularity over the past decade, but I can often see a lot of partially untrue information looming around on the internet, so I'll be helping clear a few misconceptions and cut through the jargon, and can also help you find the best option when buying a brand new car. PCP Finance is the abbreviation for personal contract purchase. It's essentially a combination of leasing a vehicle for personal use and the more traditional hire purchase method of buying something via regular installments. This is why every new car advert now promotes prices from amount per month rather than total new purchase price. Say for example you wanted to purchase a new car which has a cash price of £30,000. Now you could, if you wanted to, purchase this car outright there and then, and the car will be 100% yours. But if you're like me, or most people I suspect, you won't really have a large amount of funds just locked up and you can just justify to go ahead and splash it out on a car. There are other things to spend on after all. But with PCP, the dealer can give you a more affordable way to purchase this car. And yes, I use quotation marks there because you have to remember, for something to be affordable, it's always relative, and so you can never take the term at face value. But say you've chosen a PCP option, the dealer says to pay 10% deposit up front, so that means £3,000 initially, and then you can pay a much more manageable monthly fee of £563, and you can choose to pay this for each month for say 48 months. And you can tinker with other options as well, which is the expected annual mileage, and this will always adjust your monthly fees. And during those 48 months, the car won't legally be yours until you pay the dealer the full amount. However, you will still need to pay for other fees such as road tax, insurance, and obviously fuel for the car. It seems simple enough, and you'd probably be wondering, why doesn't everyone do this? I mean, you'd be still paying the same amount at the end of the day, right? Wrong. The dealer will almost always charge an interest rate alongside this, meaning that you won't just pay the 3k up front, have a monthly fee of £563 for the course of 48 months, and then the car is yours. Now you have to understand that this is a business too, and the car dealer would want some kind of interest out of this. Some car companies offer around 5 to 12% interest, which means your monthly fees will drastically go up. Suddenly now you're paying over £600 per month, and this is still a lot. So Sumit, what do you mean by more affordable? This is still a large portion of my monthly salary. And you're right. And this is where PCP becomes a little bit more complicated. A dealer will then typically offer a final balloon payment at the end of your contract, and this will be outlined at the start of your payment plan. This balloon payment is also referred to as a car's guaranteed future value, or GFV for short. This is essentially what the dealer suspects the value of the car will be at the end of your term. It's calculated using various instruments, including how many miles you've added to the car, the overall condition, and how saturated the market is for the exact same model, i.e. supply and demand. All of these factors plus more can affect the final guaranteed future value. Some car companies mask this term and call it the balloon payment or optional final payment, but what you should really do is refer to this as the approximated value of the car at the end of your term. It'll give you a good indication for what you can later sell this car on for if you wanted. So in this example, we're going to say the balloon payment or guaranteed future value is £15,000, meaning that after your contract ends in 48 months' time, the value should be around 15k. So you can see here then that once I enter the figure, the total loan amount decreases massively, and the same with the monthly payments, as the contract is assuming that you've only borrowed the car for 4 years, and so you'll only be charged for how much the car will depreciate by, plus the interest and other dealer fees. After that, it's not really your problem. You'll be given 3 options at the end of your term to either A, pay the final balloon payment and then the car will be yours, or B, you can opt to give the car back to the dealer and you will not have to pay a single penny further, or C, you can exchange your car for another one offered by that same dealership or another one. Best tip is to stick to the same dealer, and I'll explain why in just a moment. So that's essentially the nuts and bolts of it, and hopefully that'll give you a good foundational understanding for this type of car finance. Now, there's a few other important things that you need to consider. The 2 biggest components of your monthly costs come from the APR and the guaranteed future value. The APR is the interest you'll be charged for borrowing. You want to minimize the APR as much as possible. The lower the rate, the less you'll have to pay. Therefore, it is important to keep on top of this aspect. Going back to the example before, the rate was set at 5%. But equally, some dealers will charge a higher rate, and it isn't uncommon to see people paying 10% or even more than this for their payment plans. At 5% we had £339 per month, and come to 10% we have £429 per month. That's nearly £100 extra each month, and over 4 years that amounts to thousands of pounds extra that you'd be spending. Now, BMW currently offer plans from as little as 2.9%, which isn't all too bad when compared to the average personal bank loan that you can get from a high street bank. The rate you are given is mostly driven by your own credit score. The better the credit rating, the better rate you'll get, and this is also true for most banks who do discriminate between consumers based off their score. You can check your own score through sites such as Experian or ClearScore, but I have to warn you, these are actually going to show in your credit file, although they are actually soft searches rather than the hard searches that you get from lenders. Now, some dealers have now started advertising that they have set an APR at a fixed rate regardless of your credit score, and obviously that's a good thing if you have poor credit or actually no credit to your name. The second major component is the guaranteed future value, or the balloon payment at the end of your contract. Now, this single sentence is going to be the best bit of information you're going to get on this type of car finance. Your goal is to get the guaranteed future value as high as physically possible. Now say it with me. Your goal is to get the guaranteed future value as high as physically possible. Don't be fooled by these smaller balloon payments and be like, wow, that's all I have to pay to get a new car. You should be thinking, wow, I've got a 30 grand car and now the value of my car is only 10k, meaning that I really just lost 20k in 4 years, as well as interest plus maintenance fees, and I still don't have a car that actually belongs to me to show for it. The dealer will entice you to say the balloon payment is smaller, so you have more of a reason just to keep the car at the end. I mean, after all, you have spent a lot of money already, and it just makes sense to pay the final balloon payment and it's yours outright. For some, this will make sense. They've successfully paid for the car at a more manageable and easier way. For those of you who don't pay the balloon payment, seeking for a higher guaranteed future value is the kind of philosophy that makes 100% sense if you are someone who wants to switch their cars every 3 to 5 years, and this is becoming more and more common among people. The majority of millennials and even older generation folk are treating their cars like their phones, where they upgrade their handset every few years to get the latest and greatest iPhone. And it's true that the 10-year average for consumers who switch their cars through financing plans like this will tend to spend more on average than those who stick to one car for 10 years by just paying outright. But that's besides the point. But if you are the person who will change their car, then 100% find a car which will retain its value longer and have a higher balloon payment at the end of the term. There's also another point to mention, and that's the GFV is the lowest guaranteed value of the car that the dealer is willing to go. However, it's likely that the market value may not actually depreciate by that much, and that's a much better position for you to be in. Let's use the same example from earlier. We assumed that the GFV was 15k, so that's the least the dealer will say that the price of the car will be by the end of your term. But say for some reason the car's true life market value is actually more, say 17 grand. That's 2,000 more than the initial balloon payment from before, and it means that you now hold some equity in the car. Now you can do a few things with that extra bit of equity. You could either get the dealer to pay you directly, or you could decide to exchange the car and then have the remaining being used as a down payment for your next set of wheels, and this is what most will do. I also mentioned earlier that often it may be beneficial to stick with the same dealer for future cars. This will differ between providers, but if you show some dealer loyalty, they may actually choose to contribute towards your down payment for the next car you choose. So you will use the extra 2k, add their contribution, and now your own stake in the car is slightly inflated despite not actually putting more of your own money into the car. Now that's a lot to take in, but here's the glue that will piece everything together. I'm going to summarize everything that I just said. You will pay an initial down payment or a deposit for your car. You will also agree on an optional final payment, which remember is the same thing as a balloon payment or a GFV, it's all the same thing. Now based on these two parts, you will also pay fixed monthly payments plus the interest, which is calculated off the full list price. Now just remember that the GFV plus the deposit will be taken off the full list price, and that's how you calculate the monthly payments. And that's the major difference between PCP and other types of car finances. In PCP, you have the GFV, you have the optional payment at the end of the term. With other car finances, this isn't possible. And this is what makes PCP monthly payments that much lower. Now, it's not just new cars that the payment option works on. A growing number of UK manufacturers and dealers will now give these options for second-hand vehicles too. And this is where a lot of new people, I suspect, will enter the car financing route. People will allow most of the depreciation of the car to happen in the first 2 to 3 years of its release, and then they will enter the market space. They're letting the list price and the final balloon payment come closer together, meaning that when they get the car on PCP, they won't be losing too much of the car's value as it depreciates. You get a fairly new car at a decent monthly rate. And there's a couple of other things that you'd want to look out for when you're purchasing a new car. Now, depending on where you live, this may be more relevant to you than others, but if you're living in a city like London, then you're going to be affected by things like ULEZ and congestion charges. You need to make sure that your car meets the local area's emissions guidelines so that you don't run into other problems and any other charges. Check out my previous video which covers this topic in depth. So there you have it, that's a brief introduction to how you should look into PCP. Now you also have to remember that there are other types of car finances to consider. There's the personal contract hire and the hire purchase, which have their own benefits and drawbacks. Hire purchase is a simple type of car finance. You'd pay the initial deposit and then fixed monthly payments over an agreed period. The car isn't yours until you pay the final payment, and it means that the loan is secured against the car, so if you miss a payment, you could lose the car. Then there's personal contract hire, or PCH, where you will never actually own the vehicle. The car will always be hired and must be given back to the dealer at the end of the term. Typically you will not have to pay for anything like servicing or any tax for this car. You will only need to worry about the fuel. What I'll probably do is have a highlights section on my Instagram and have all the key points on that page, so make sure you're following Vulcan Motorsport on Instagram right now. And obviously if you found this video helpful, please give it a thumbs up as I'm trying to get this whole channel off the ground. I make motorsport documentaries, car reviews and other hopefully useful videos, and if you could share this video with anyone you think might benefit from this guide, that would go a long way. If you do have any questions, please do leave them in the comments section, and who knows, maybe someone else is thinking the same thing, and then we can all collectively help each other. Awesome guys, thanks for watching, we'll catch you on the next one.